Ladies and gentlemen, good day and welcome to the Q3FY22 earnings conference call of Solar Industries India Limited, hosted by Nirmal Bang Equities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Bhandari, Research Analyst from Nirmal Bang Equities. Thank you, and over to you, sir.
Yeah, thank you, Rutuja. On behalf of Nirmal Bang Institutional Equities, I would like to welcome all the participants on the call of Solar Industries. From the management, we have Mr. Manish Nuwal, CEO and Managing Director, Mr. Suresh Menon, Executive Director, Mr. Monish Agarwal, Joint CFO, and Ms. Shalini Mandana, Joint CFO on the. I would like to hand over the call to Aanchal for opening comments, post which we will open the floor for questions and answers. Thank you, and over to you, Aanchal.
Hello everyone, and wish you a very happy new year. I am Aanchal and I welcome you to earnings call of Solar Industries India Limited to discuss Q3 FY22 earnings. Joining us today on this call is MD and CEO Mr. Manish Nuwal, Executive Director Mr. Suresh Menon, Joint CFO Mrs. Shalini Mandana, and Mr. Monish Agarwal. Please note that certain statements concerning our future growth, certain statements regarding our future business expectations intended to qualify for safe harbor, which involves a number of risks and uncertainties that could cause actual results to differ materially from those in such forward-looking statements. Now I request Mr. Manish Nuwal to give opening remarks on the stellar performance of the company. Over to you, sir.
Thank you, Aanchal. Once again, a very good morning to all the valued investors. The strong growth and meticulous execution in all the sectors has helped us to exceed quarterly revenue of 1,000 crores, which is up by 58% year on year, and achieved highest ever quarterly profit of 105 crores, up by 30% year on year. The current results gives us confidence to revise our revenue growth guidance to 50% for the financial year 21-22. Surpassing our earlier guidance of 40%. We have been able to achieve good EBITDA and PAT during the quarter despite of steep and unprecedented hike in commodity prices across our business verticals and currency volatility in our overseas subsidiaries. The defense sector have started contributing to the top line along with other sectors like mining, housing and infra, exports and overseas. And we expect this momentum to remain strong due to government emphasis on Atmanirbhar Bharat, Make in India, Gati Shakti scheme, Pradhan Mantri Awas Yojana and Housing for All, which augurs well for our industry. With our continuous focus and strategic investments in products for defense applications and new geographies, we are well placed to continue the growth momentum and maximizing the value for our stakeholders. I now hand over to Aanchal to take you through the summary of financials. Thank you.
Thank you so much, sir. I'm extremely happy in presenting the numbers of another record-breaking quarter, where we have crossed the revenue of 1,000 crores for the first time in the quarter. We grew at the fastest pace in Q3, registering revenues of 1,018 crores, up by 58% year on year. EBITDA stands at 185 crores, up by 28%, whereas PAT stands at 105 crores, up by 30% year on year, demonstrating the strength of our business. Now let's quickly review the quarter in detail. Explosives. The domestic volumes in the quarter are increased by 21%, that is 104,717 metric ton compared to 86,265 metric ton. and our realization of explosives is up by 52%, that is 49,000 per ton compared to 32,304 per ton. As such, explosives revenue was up by 84% from 279 crores to 513 crores. Revenue from initiating systems was also up by 10%, that is from 92 crores to 101 crores. Now coming to our customer breakup, revenue from CIL was up by 96% year-on-year from 98 crores to 192 crores. Revenue from non-CIL institutional was up by 102% year-on-year from 73 crores to 147 crores. Revenue from housing and infra was up by 29% from 166 crores to 215 crores. Exports and overseas revenue grew by 35% year-on-year from 280 crores to 377 crores. Defense revenue was up by a stellar 218% year-on-year from 23 crores to 73 crores. Coming to our cost breakup, raw materials, the consumption year-on-year is increased by 4.47% from 54.45 to 58.92 as a percentage of sale. In absolute terms, the cost is 600 crores against 352 crores. Employee cost has decreased by 2.59% from 9.21 to 6.62 as a percentage of sale. In absolute terms, the employee cost is 67.39 crores against 59.48. Other expenses has increased by 1.10% from 15.87 to 16.97 as a percentage of sales. In absolute term, other expense cost is around 173 crores against 103 crores. Interest. The interest cost is decreased by 0.37% from 1.69 to 1.32% as a percentage of sale. In absolute term, the interest cost is 13.41 crores against 11 crores at cost. Coming to highlights for 9 months, we registered a revenue of 2,631 crores, which is up by 53% year-on-year. EBITDA stands at 503 crores, which is up by 36%. PAT is at 281 crores, which is up by 46%. Now, we would be very happy to take any questions, comments, and suggestions that you may have. Over to you, Mayank.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants to ask a question, please press star and 1. The first question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi, good morning, sir. Am I audible? Hello?
Yes, please.
Yeah. So, sir, thanks for the opportunity. So, just couple of things. So, just starting out with, the whole capacity expansion program for, the other parts of the country as well. Has there been any finalization on that up till now, or do you come back in the subsequent quarters? Any thoughts around that? If you can just start off with that, sir.
Yes, our expansion within the country is still in progress and will be communicated once things are materialized. It is still in progress, and it got a little delayed because of COVID, and it did affect us.
Okay. The other thing is just coming to margins, and please help us understand, because your earlier guidance of that margins was much higher, but while the revenue growth has been much strong, led by better volumes and realization increase, overall margins has been lower. So how should one look at it, given that raw material prices have increased so much and subsequently the realization? Should margins optically look lower, and that's why one should, estimate lower margins going forward, and it is more on a per ton basis. How should one look at it? If you can just help us understand on this aspect, it will be helpful, sir.
When we started with the year, we never knew that the rise in commodity prices has been so steep, and it's an unprecedented rise. It's been rising quarter on quarter. So we always have been saying that there's always a lag, because with the customers we do have the rise and fall clause, but the lag is always there. So even in the current quarter, the lag has been seen. So, and coming to the year margin, we feel the margin should be around 19 to 20%. And another factor which affected our margin was the currency fluctuations. As we know, in Turkey, during the quarter, there was 47% depreciation in the currency. So during the quarter, we were hit by forex to the tune of 37 crores. These two factors had affected our margin, and we see the year margin should be around 19 to 20%.
Ma'am, which year are you referring to in terms of margin guidance?
Current financial year. FY21-22.
You expect margins to be 19%?
19 to 20%.
And going forward, how should one look at the margin profile?
As you know, this quarter progresses, and as we see, how the raw material prices stabilize, so we'll be able to comment in the next quarter.
Okay.
There should be improvements going forward.
Okay, but sorry, this 47 crores of forex impact, is it sitting in the 173 crores of other expenses?
37 crores, yes, correct.
So that other expenses is inflated to the extent of 37 crores because of the Turkey currency impact.
Correct.
But overall, you believe even with these raw material prices, 20% base case margins on a sustainable basis is possible. There is not much change there. Is that a fair statement to make?
Yes.
Hello, am I audible? Hello?
Yes, you're audible.
Okay. Do you think, sorry, I couldn't hear you, ma'am. So you're saying 20% margins on a sustainable basis with these raw material prices is fair to assume?
Yeah, it is fair at this current level.
Okay, great. And just one more thing in terms of the raw material price increase that we have seen, how much it has been passed on and what's the current trend on the raw material prices? Any color there would be very helpful.
As in when the price rise, we try to pass on, but we have different types of contracts with the customers. For example, Coal India, we have 3 months contract. In some customers, we have monthly contracts. So it takes generally 2 to 3 months to pass on the prices.
Okay. The raw material prices have now stabilized, or are they still on a continuous rise?
It's on rise, not yet stabilized.
Okay.
But next quarter, maybe 3-4 months, that should stabilize.
Then the overall currency depreciation and other things would be now loss making for you?
Yeah, currently in this quarter we have faced the losses.
Okay. The other thing around is that if you look at the 9-month basis, your broad capex is about 200 odd crores. Your debt has increased by almost about 200 odd crores, despite generating an operating cash flow of almost in excess of 300 odd crores. So is it that the working capital requirement because of raw material price has moved up sharply? If you can just give some color there, because the balance sheet is not available on 9-month basis, that will be helpful.
Yeah, the major reason in increase in working capital is with the rising commodity prices. The sales also have grown up by 58% during the quarter, and 9 months 53%. So, but if you see on the debt EBITDA level, we are maintaining at 0.53.
Okay. So is it fair to assume that that and if the capex is at that run rate of 200 to 50 odd crores, and if raw material stabilizes, there will not be any further deterioration. And I'm thinking, will there be free cash generation which will happen into the company going forward? Some around that would be helpful.
Yeah, the capex should be around 250-300 crore, as we had been seeing 300 crore year on year for next 2-3 months also. And the prices of the raw materials, since all the commodity have risen, so prices has risen, so obviously capex will remain at that level. And as we have been saying, the company, the policy of the company is to maintain the debt equity around 0.5 base. So that shouldn't increase going forward.
Questions. One is broadly outlay this 250-300 crores capex into where will it exactly kind of go into domestic and overseas?
So like she was explaining that our capex outlay will be in the range of 250 to 300 crores. This is mainly because all the items which is going for the capex, the prices has gone up and it is being reflecting everywhere. That's why it will be in the range of 300 crores plus. And looking at our future expansion plans in India and overseas and expanding the product portfolio of defense, definitely it will remain in this range. And we have been spending the amount mainly for expanding the geographical expansions in Indian market, defense products, and expanding footprints outside India.
Okay. Manishji, just one thing in terms of if you can just help us understand your thought process, how are you looking at the overseas market in terms of adding more, countries to the overall bouquet, and how should one think about it? How are you looking? Are there still many such countries where the addressable market size of explosives is higher, and are you looking at it? So if you can just give us broad strategy for next 2-3 years, it will be very helpful, sir.
As you are aware that our presence outside India mainly is in Turkey, Nigeria, Zambia, and South Africa. And in last 1 year, we have added the countries like Ghana, and now Tanzania plant is also operationalized. So our focus is to expand expand our presence in nearby markets wherever we are present. Our interest is not to go outside those territories. Our expansion in Australia also in a finishing stage, and probably in next 3 months we should start the operations. So as far as our strategy is concerned, it is always being part of our strategy to expand our presence so that we are least impacted due to presence in one geography and one product portfolio. That is what we have been following.
So you will follow the cluster-based approach that you typically follow, one by one. That's the way you.
Absolutely, absolutely.
Questions. One is, while you have guided for the 22 to be a strong year of that, 50% growth, any thoughts on subsequent years given the overall, capacity addition of new countries and also the domestic market? Any thoughts? So I know the raw material prices, but I'm on a volume front, would you be able to guide what should be the, growth that one should expect over maybe next 2 to 3 years from solar?
In our previous quarter call, we have said that in this year we are expecting a growth of 40%, which has been revised to 50%. And we have said that volume should increase around 15 to 20%, but with good results or because of good demand and our focused approach in those markets where we are present, our volume has already increased on 9-month basis by 27%. So definitely we have crossed what we were targeting actually. And in coming years, we believe that the volume growth should be around 15%, and in value terms, it should not be less than 20%. But we don't know how the market will unfold. So conservatively, we can expect that our revenue growth should be around 15 to 20%. And we maintain that despite of strong growth in this financial year.
Great, that's good to hear. So just lastly, on thoughts on your defense, how are you looking at it? How are the opportunities? And the most important thing is getting conversion into order book and execution. Just your thoughts there. Thanks.
Yeah. If you see this quarter result also, in this quarter, we have already crossed the sales of 70 crores, and in 9 months, our revenue from defense is already 176 crores. And in the last quarterly call also, we said that we are expecting the sales from defense product should be around 250 to 260 crores. And based on these numbers, we are confident that in this financial year, we will cross 270 crores. And for the next financial year, we will definitely give a guidance in Q4. But like we have already said in previous calls, that we are targeting 350 to 400 crores in the next financial year. And we believe that it is a possible number based on current order book and the speed of conversion which has started.
Okay. Okay, Manishji, thank you so much and wishing you and your team all the best. Thank you so much, sir.
Thank you, Abhishek.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Shivang Joshi from Centrum PMS. Please go ahead.
Hello. Good morning, sir, and congratulations on good numbers at the revenue level. Sir, I'll start with the overseas subsidiaries. So, as you said, that Australia, you are saying that it will be operational in the next 3 months. But on South Africa, when are we now expecting the operations to break even?
We are expecting that in the next 3 months, we should reach to the break-even level at EBITDA level first. And in next financial year, we are expecting that we should be out of the losses. And this gets delayed, like we have explained, due to various factors. And things are getting in control now. We are in a better position now.
Okay. Now, just taking that ahead, actually, when I try to look at the subsidiary or the geography level growth in the last 3-4 years from FY18 to 21, we see that we've seen quite a strong growth in geographies like Nigeria, South Africa, but Zambia and some other subsidiaries have not grown that well as far as the revenues and PAT are concerned. So what is your outlook, if you could just give an idea about the existing geographies?
Yeah, we expect that in all the geographies, wherever we have strengthened ourselves, should grow at 10 to 15% because we have fairly large market share in countries like Turkey and Nigeria. And in countries like Ghana, South Africa, Zambia, there is a potential to increase our market share, and we are trying to do that. But since we are aware that business dynamics keep changing, so looking at all the parameters, we believe that the growth from overseas will also be around 20%. And on a group level, we expect that revenue should be around 15 to 20%.
Okay. So slightly deep diving on the new geographies, specifically Australia and Tanzania. So Australia, when you say that so what is your target market in Australia? I mean, what levels do you see your revenues going up in the medium term, the next 3-4 years?
Our first target was to set up a greenfield project in Australia, and despite of various challenges in last 2 years, we will be able to start that operation. And once we stabilize in next 1 or 2 years, then we will be able to give more clarity on business or countries like Australia. So it will take some time.
Okay. The only reason is, do we expect them to be a 100 to 150 crore kind of market like Nigeria, Zambia, or South Africa, or do we expect that market to be as high as Turkey? I mean, that was the sole purpose of these questions. Because Turkey, I believe, is roughly 350-400 crore market, whereas the others are less than 200 crore at the moment. So
we will be able to give more clarity on this market within next 2 to 3 quarters. So we will have to wait for that much time.
Okay, that's fair. Next, sir, on the domestic, so on the defense, could you give us the number of the defense order book, sir?
Yeah. The current order book for defense products is 537 crores.
Okay.
537, right.
Okay. And see, currently, if I'm not wrong, going back to exports, because we are seeing a similar growth levels for exports and domestic, at least 20% levels. Currently, exports, if I'm not wrong, is contributing to how much to your total revenues? 40% or higher?
Yeah. In this quarter, the share of export and overseas is 37% of our sales, and we believe that it should be around 40% going forward.
Okay.
Yeah.
Okay, sir. I think that largely answers my question. I'll get back in the queue in case I need some more clarity.
You can always connect us, no issue.
Thank you, sir. Thank you so much.
Thank you.
Thank you. Participants, to ask a question, please press star and 1 now. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for great set of numbers. So my question is on the initiating systems. When I look at this product category, the growth has been below the growth of the others. So if you could just walk us through on this segment, and is there a correlation between the growth in the initiating systems and other explosive business?
Actually, there is no specific reason for less growth in accessories section, but because of some delays in shipment to various parts of the globe is one of the major factors, and we were also trying to rationalize the inventory levels into the system. So that is one of the key reasons for this. Otherwise, I think from next quarter onwards, we will see better numbers from initiating systems, like accessories and initiating systems.
Sure. So is there a rule of thumb, let's say, if we sell 1 kilogram of explosives, then X grams of explosives, the accessories goes, or maybe in the rupee value, is there a rule of thumb?
I said there is no thumb rule because everybody use different level of initiating system based on their requirements. So it is difficult.
No, I understand. Could you give us some color on the international the performance of the international subsidiaries, how it has been in the 9 months?
For the quarter, the sales from export and overseas is around 37%. So as Manish has recently said, that should be around 40%. And the year-on-year growth in international subsidiaries should be around 15 to 20%.
So actually my question was individually on a 9-month performance, if you could share what has been the growth for the individual subsidiaries, not the full numbers, but on a guidance basis, just to help us cater how they are performing on 9 months to look at the performance. That is on an individual subsidiary basis, especially for the international operations.
As a matter of a company's policy, we do not give detailed bifurcation. We consider export and overseas under one basket. And the trend of this one basket of export and overseas has been already indicated.
And the details will be there in the annual results.
Fair enough, no problem. Just last question from my side. Indonesia, if you could give us where are we? We were looking to expand within Indonesia. And if you could give us some color, like because we were already exporting to Indonesia, so will there be some substitution, and what's the level of substitution of the current revenue base?
We have started setting up a small facility in Indonesia. Work is already in process, and we believe that in next 6 months some operations will start. Our object will be to stabilize that operation and then expand gradually.
Sure, thanks. So is there a current exports to the Indonesia that will get substituted by local facility?
There will be, we are already exporting a lot of products to Indonesia, and with that facility, some of the products will shift from India to Indonesia, and some another series of products will start exporting to Indonesia. So overall, it will be in the interest of our company to start those operations.
Sure, sir. This last question from my side, as you highlighted that the capital expenditure could be in the region of 250 to 300 crores, and we are expecting a growth of 15-20% on the revenue. So capex as a percentage to sales will keep dropping, and consequently we will see free cash flow going up. If you could help us share on the capital allocation, can we expect a increased dividend payout? Your thought of keeping some debt is always good for return on equity, but is there a thought of increasing the payout ratios?
Looking at our capex plans, we are still in a growing stage, and there are various opportunities available in different and Indian markets and even international markets. So as of now, we have no such plan to increase the dividend payout. We would like to conserve the cash flow for our expansion, and we have seen that that strategy of conserving the cash, utilizing it for our strategic expansions program, is giving better results to us.
Good. We appreciate. Thank you so much for taking my questions.
Thank you, Ravi.
Thank you. The next question is from the line of Lakshmi Narayanan from ICICI Prudential Asset Management. Please go ahead.
Yeah, thank you. A couple of questions. First is that from a Q1, Q2, Q3, Q4 basis, right? Usually, how on a steady state basis, how seasonal is the business?
We have not understood your question. Please repeat again.
No, my question is that, I mean, across the 4 quarters, is it that Q4 the numbers are in general lumped up? So, for example, if you do 100 crores of turnover in a year, is that what is the proportion of Q1, Q2, Q3, Q4 in general, and whether that is going through some change now?
Normally, as such, the Q4 is always the best. And looking at the past trend, and even in this financial year also, whatever results we have achieved, we believe that Q4 should be better than the Q3.
Got it. Yeah. And if I just look at your business, over the next 3 years or even 5 years, right? What percentage of business would come from current customers, and what percentage of revenues you think would come from a new business from new customers? I mean, how the build-up is going to be over the next 3 to 5 years from where we are now? Where is the growth? How will the existing customer base requirements will grow, and how will the new products will grow, and how will the new business from new customers would actually grow? Just a sense of the business.
Yeah. If you look at our strategic investments in last 5 to 10 years, we have invested a lot in defense and international business and expanding the product portfolio in our current facilities at Nagpur. So if you look at those investments and the future prospects, definitely we see that the customer segments like exports and overseas will be one of our key component of our business, and defense is picking up, and we believe that it should reach to around 15%, 20% in next 3 to 4 years time, and overseas will always remain around 38, 40%, maybe 1 or 2% here or there, and the balance will come from the Indian market. And to strengthen our market presence in India, we are expanding the geographical footprint and increasing the production facilities or capacities of the initiating systems and other products. We are continuously developing various products are of high-end technology, and companies never faced any problem due to these things. So our strategy is very clear and simple, and we are following that.
And in terms of the bottlenecks for your growth, right? Is it the competition in India, material availability, or people availability, right? People who can go and sell the products, etc. Where do you think the challenges are in that order?
Business challenges are always common for most of the businesses, like getting a customer, getting raw material from right vendor at the right price, and managing the team to sustain the current businesses and expand the businesses across the globe. These are the basic challenges, and we believe that we are very much comfortable to handle all these things.
Got it. Because a couple of years back, there were challenges in raw material availability also to an extent, I remember. So I just want to check whether all those things have been addressed. That's the reason of asking you this.
Yeah, you have raised a very fair question. It is not like that it is not a challenge. Getting the raw material continuously to our campuses and delivering the product on time to our customer is always a challenge. But if you look at our last 10 years of track record, we have fairly managed it very well. And in this year and even in the previous year, when most of the companies were struggling because of COVID and supply disruption, like ocean freight has gone up, you are not getting the vessels, we have fairly managed our businesses, and there is no any specific disruption in our system. And that's why we are able to grow in this year also. Our volume has increased by 27%. And top line has increased by almost plus 53%. So this reflects that there are challenges and we are managing them well.
Got it. And the last question from my side is that you've been subject to currency fluctuation, which has resulted in a forex loss absorption this quarter, right? And what are the steps you have taken from a corporate finance or / treasury point of view to ensure that the currency fluctuations or losses are actually minimal? Because as you expand, this is going to be an issue for you or a challenge to handle. So how have you covered your hedges? Have you changed your hedging policy? I just want to hear from you on that.
We have taken some measures like invoicing the customer in US dollar, reducing the dollar exposure in each subsidiary, and increasing capital in those places. So we have playing all these things, and we believe that we should be in a better position in next financial year.
Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Hi, sir. Just some few follow-ups. Just in terms of the competitive intensity scenario, how are you seeing in the marketplace? Some comments there would be helpful.
Explosive market in India is always a very competitive market, and nothing major has happened which gives us or to indicate any specific thing. So competition is there, and we are managing our businesses by maintaining the profitability at a healthy level. That is the achievement of our company, and we believe that going forward with our geographical expansions in different parts, we will be in a better position, which will help us to increase the market share as well.
And sir, your presence in the overseas market in those 6-7 locations, are you like having dominant market shares like in some of the geographies which you have? The newer geographies that you are adding, are you a dominant player with like market shares of 20-25%, or are you a marginal player in those new regions?
In Turkey, we are plus 20%. It should be around 20-23% market share. And in Nigeria, we are having more than 40%. In rest of the countries, we are in a range of 8-10%. and we believe that these market shares will keep going up.
Okay. Just one more thing, continuing from the previous participant's question in terms of the sourcing of the raw material. Now, during this unprecedented hikes and price increases, have you seen the unorganized guys, their sourcing has been an issue? Have you seen anything of that kind of a thing at the marketplace? Because you have the capital balance sheet and your MOUs are very different. So for you to source is much easier than probably those marginal guys. So any thoughts around this, sir?
I believe that in last 2 years, what we have seen that one was the COVID, and because of COVID, there was supply disruption in a second phase. And now in this phase, we are seeing that commodity prices has gone beyond imagination. So these three factors have definitely weakened the smaller players, which is mainly unorganized players. And this is what we have been seeing, that the weaker players will definitely be more weaker. But our aim is to increase market share by maintaining the healthy margins. So we are following that strategy, and we have been successful in that.
Just two more questions. In terms of the housing and the infra segment part of it, now what we understand is there are two elements. One is the roads part of it. Second is the explosives going into the housing element. Now we hear a lot of demand for real estate and other things coming up. Is that something that you are already seeing your explosive? Because you are at the early cycle, right? Because at the initial stages. So are you seeing that kind of thing happening for your explosive demand aspect?
Based on our observation from the market, it is very clear that due to increased working capital requirement, many of the contractors have slowed down their work, and as a result, demand from infrastructure is not as bullish as it was in the last year. But in housing space, definitely it has increased, which has balanced. So these two factors are quite visible. But we believe that everything is balancing out, and there is a decent demand, but prices has gone up a lot, which is impacting the demand in short term. But I believe that in couple of months it should be again on a growth side.
Okay. And so just one last question. In terms of defense, the current gross block have, what is the peak revenues that you can do out of that?
The gross block and all those will be part of our balance sheet items. So I will be able to give more insight in next quarterly call.
Okay. But I'm saying, can you do 1,000 crores of revenue of defense given the current asset base in defense? Or
absolutely. Absolutely. We can definitely do that very comfortably.
Okay. Okay, Manishji. Great. Thank you so much.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Yeah, thank you for the follow-up opportunity. The question is on the Pinaka. There were media reports suggesting that the Army has conducted the second trial in Pokhran. So if you could give us an update, where are we on the Pinaka, and when can we expect materialization of orders?
Few things. First is that our Pinaka Mark 1 was already qualified, and our Pinaka Enhance has been successfully, trials has been conducted successfully at Pokhran in recent past, and we believe that RFP should come out soon after the A1 was cleared by the Defence Acquisition Council. Our Pinaka guided rockets are also going to be fired soon, and we believe that in couple of months they should get tried out. And once those things happen, we believe that RFPs will come in place and we will be able to start the production, as we are a production agency for most of the Pinaka series products. As and when RFP will be floated out, we will definitely share with all our valued investors.
Right. So we can expect the RFP for the enhanced version in the next 3 to 6 months. Is that a fair assumption?
I will not comment on that, but definitely we are expecting it to come out soon.
I understand. Defense is an uncertain sector. That was the only follow-up I had. Yeah. Thank you so much.
Thank you.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
No question really, Manish. I just wanted to convey congratulations to you and the entire Solar team. This year has been like a departure from the past, and in a positive way. And I hope the tempo and the strength grows from year to year. So just wanted to convey my good wishes.
Thank you, Bharat Bhai. Thank you, Bharat Bhai. Thank you very much.
Okay. And just one thing, domestic market, what will be our share?
Sir, it's around 24 to 25%, sir.
24%. Okay. Thank you, Manish.
Thank you, Jay.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yes, thanks for taking my question. So the first question is on the EBITDA guidance that you gave of around 19 to 20% for the full financial year with a 50% top line growth. I mean, that implies almost a 22% EBITDA for the last quarter. So just curious, is there some visibility on the overseas locations because 22% margin was last seen in Q3FY18? And with this kind of a raw material environment, is anything changing at the margin to sort of have that visibility of extremely strong Q4?
If you look at 9-month result, it is already plus 19%. And in the Q3, there was a big impact of correction, which Shalini has already shared. If you factor in that into the results, definitely you will also see that the target of 19 to 20% should not be a problem. So we are trying for that to reach to that level, and we are also confident that whatever measures we have taken, we should be reaching to those numbers.
Okay. My second question is on the forex loss. I think we mentioned 37 crores. There is a other comprehensive income loss of around 26 crores which has been reported for the quarter. So is the forex loss also included there plus the other expense line item? If you can just clarify on that.
Yeah, we will definitely clarify.
Yeah, some amount is there also. Some amount of forex loss is included in OCI also.
Okay, so total forex loss is 37 crores or the one that is included in other expenses 37 crores?
Total 37 is in the profit and loss. That is included in other expenses and some part in OCI.
Okay, great. The third question is on the defense EBITDA. Now we have done a run rate of 72 crores or around 70 crores in the current quarter. So have we sort of broken even on that business for the quarter? Because I think the previous run rate was 65-70 crores around this run rate only. So just thought we'll check.
It is difficult to give the break-even level for defense at this stage. So once we definitely reach to around 350-400, we will be in a better position. So as of now, definitely our first target was to reach to 100 crores number. So fortunately, we have, after all the challenges, we have already crossed 70 crores. In next quarter, we are expecting that we should cross 100 crores. So these things will definitely help. These numbers will help us to reach to break-even level numbers, and that's why we have said that the EBITDA margin should be around 19-20% because of all these factors.
Got it. No, that's clear. Second, actually, fourth, sorry to ask so many questions. If you can just highlight briefly on Skyroot Aerospace, I think in May 21, you have taken part in Series A funding round of $11 million, which they raised, and they have been doing pretty good work. I mean, we keep on reading. So, if you can sort of highlight the developments that you are seeing there and, the valuation that those entities, drawing and, the business potential that you see from there.
Definitely, we have invested in that company with a strategic intent that we should be part of the products which will go into the space. And with that intention, we have invested, and we are an exclusive supplier of propulsion system to them. So with this strategy, we have invested in them, and they are doing pretty good. And once their rocket is launched and successfully, definitely valuations goes up for those kinds of companies, and that will also help us a lot from two factors. First, from investment angle. Second, from continuous supply of our finished products to them. So let's see how they progress and launch the vehicles. If they do it successfully, then they will definitely be the first private sector company to launch the space vehicle successfully from private side.
Right. We'll keep following that. And last, there is a suggestion. I think this overseas business is becoming a really big chunk of your overall revenue now. So please, if possible, start disclosing the volume, the tonnage data like you do for domestic segment. That would be really helpful. Thanks. That's all from my side.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss. Please go ahead.
Yeah, hi sir. Good morning and congratulations of a strong set of numbers despite current volatile environment. Sir, a couple of questions. Sir. First is on this the customer acceptance of these higher prices. Now we see that explosive prices has almost gone up from almost 30,000 to 50,000 rupees per ton in the current quarter. As you mentioned that the prices are still on rise, mainly driven by the price input cost increase. How has been the customer acceptance? Are you seeing that there can be probability of low downgrade in the input prices, or they can move to some other material like Afghan and all as far as the mining materials are concerned?
Definitely there is a big reluctance within the customer fraternity to accept these higher numbers. But we have been able to convince them that these prices are because of various international factors, and those are impacting the demand from those customers. But if you look at the supply related constraint, then definitely the availability of raw material is not pretty good at this stage. So demand is there, but prices are dampening the demand. But we are able to maintain our market presence across the geographies.
So do you see that you have been able to maintain the market share, or it has grown up because despite the input cost increase and sharp rises in pricing, you have still managed almost 27% kind of volume growth in last 9 months? That's pretty decent, and I'm sure that the industry would not have grown at that pace. So doesn't we have gained market share? And also on the contrary, that despite such a sharp price increase, the volume growth has been pretty solid. So what has been the contributing factor for this volume growth? That my second question was the contradiction to our first question, that despite such a price increase, we have been able to probably gain market share with a 27% volume growth, which even exceed your earlier expectation of 15% to 20% volume growth guidance. So are we gaining market share, and is this gain of market share is coming on the cost of that lower imports, or other suppliers, local suppliers are not able to meet the demand from the customer? From where this market share gain is coming, or the industry itself is growing at such a scorching pace?
So like we have already shared that the COVID was there, then supply disruption was there, and now because of very high commodity prices, a lot of people are facing the financial challenges because of from working capital side. So these factors are definitely eroding the competitiveness of the smaller players, and as a result of which our supply is not definitely is little more than what we have expected. And definitely with this 27% volume rise, one factor was that in the last year there was a COVID, and that has also reduced the last year's demand. If we eliminate that factor, then growth should be around 20%, and which is more than 15% of our target. So we have increased our little bit of market share, and as a result of which we believe that the 27% growth is there in the numbers.
Okay. Sir, do you also see that has set a high base for current year, and probably for next year there should be some tapering off in a volume growth number, like, or you still think that 15 to 20% growth on a 27% kind of growth base in the current year is possible?
Rohan, like we have said that we are increasing the geographical footprints in India, and based on that, plus based on our aggressive marketing strategies, we believe that 15% volume growth should be a reality.
And just last question from my side, sir. On accessories market, sir, we have seen roughly 9 months close to 30% growth. I understand it will be function of both volume as well as pricing. Have the price increase in accessories has not been in line or has not been pretty aggressive that what has been in basically explosive market, because it's only 30% increase, which should be the function of both price and volume. So, or there is not any significant price increase in accessories market?
It is very clear that in explosives the raw material percentage is always very high, and in initiating system the raw material percentage is always very low. And if we factor in the commodity price rise in both the sides, it is practically similar in both the sections, but the impact is always less. And that's why you must be saying that in 9 months explosive value has increased by 70% and initiating system has increased by 30%. So the rise is practically genuine, and we don't believe that any other factor in that.
So this 30%, if I look at that, it's primarily like I believe explosives and accessories goes hand in hand. So probably 27% volume growth in explosive would have led to similar kind of growth in accessories, or even generally we have seen accessories growing higher than explosive. So it's all the 30% growth in 9 months is all driven by volume and absolute no price increase?
I have already this question to Mr. Bhavin of SBI, and the reason was that there was a rationalization of inventory in our overseas subsidiaries and Indian market to our various channel partners, and that's why we have reduced the quantity sales, and it will get normalized in next quarter.
Okay. That is for myself, sir. Thank you. So thank you so much.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Mayank Bhandari for closing comments.
Thanks, Rutuja. On behalf of Nirmal Bang Institutional Equities, I would like to thank the team for Solar Industries for providing us an opportunity to host the call. If there is any closing comment from the management, we will take it up.
Thank you so much for everyone to participate in Solar's conference call, and we expect to bring you more such stellar quarter performances in the next quarter. Thank you so much.
Thank you. On behalf of Nirmal Bang Equities, that concludes this conference. Thank you for joining us, and you may now disconnect.